if it will take longer to lease up a property, your investment horizon just gets pushed out more. Typically, it always has been 3 to 5 years, but it could take 5 to 7, just depending on where we are in the marketplace and what the future looks like.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall DeCleared. Let's go, baby. All right, welcome back. Today is going to be an awesome episode. Got a question for you. Have you ever wondered who owns the retail shopping center where you buy your groceries, or maybe where you're going to get your nails done, or any of the services and that sort of thing that you use on a daily basis? Have you ever wanted to own one yourself or get into the retail space? Well, today's guest is Chris Mulling, and he is a retail specialist in the commercial real estate space with over 25 years of experience. So the guy's an expert in his field. He knows a ton of information, and we get to talk to him today and pick his brain about this space and what he's doing. So on the show today, we are going to discuss the retail space and what it looks like today and how it evolved through COVID and kind of where we are now. We also discuss the commercial real estate market a bit and just as a whole in general, and some of the opportunities that he's seeing that are coming and making their way through the system. Near the end, we're going to discuss investing in retail and what that looks like. If you're a high income earner, he has some specific strategies and product types that you should probably focus on, that he recommends you focus on. And if you are still growing your business, or maybe you're not earning as much, he also gives some advice on how to get started and some best practices that you can use to get started in the retail investing space. So get your notepad out, get ready to learn. We're going to cover a lot today, and I know you're going to get a lot from it. As always, if you're getting value from the show, it helps a lot if you can just quickly jump on and give us a like, give us a rating and a review, and it helps the show a lot. So appreciate it. And without further ado, let's jump in. Let's go. All right, Chris, thanks for jumping on today. I'm really excited to have you on. With over 25 years of experience in real estate, you have a ton of knowledge, and I'm excited to tap into that today and talk to you about what you got working on. So maybe if you could go high level and tell us where you are today, what you're working on, and what your expertise is in real estate.
I lead a team here at Avison Young of about 7. Our focus, about 75%, is investment sales and capital market large. Our book of business is both large institutional as well as private client. Our focus primarily is in the retail sector of shopping centers and single tenant net lease properties. However, we have also, especially in today's environment, a very large and growing distressed book of business with both balance sheet lenders on their REO assets, as well as CMBS special servicing and receivership work. That takes us into other asset classes, such as multifamily, office, industrial, as well as retail. We swim in the pool of about 1 to 30 million is our sweet spot. And the reason for that is 80% of all the transactions fall in that price point. From a broker's perspective, you don't have the fee compression that you have on larger deals. Yeah, they're great. They're exciting. It's sexy. $150, $200 million deals, but you can work on a $5 million deal and probably make more money than on a larger asset like that, just because of the fee compression and how involved those deals are. So anyways, our practice is all across the country. We're based in Los Angeles. However, we've closed in 48 states.
All over, yeah. So very involved. I was on the site. So when you talk about the capital markets, are you talking that's the size transaction that they look at? Or are you actually on the debt side as well, and you're sourcing debt for your clients?
No, strictly just the size of the transaction.
Got it. Okay. I didn't know if you guys had that component as well. A lot of brokers have that built in or a component.
The firm does, but our team doesn't specialize in that.
Okay. I'm again on yours. You said the distressed side is something that you guys are building and that side is coming. And so that's part of one thing I wanted to talk to you about just in general. But I think maybe let's push that down and we'll talk about that in just a minute. Because I'm curious on my end, just on the retail side, do you focus, is the major book of business single tenant, or do you do strip malls as well? Or do you do single tenant within strip malls? Or the gamut? I guess you do all of it, maybe.
It would be the gamut. Like, so for example, how we got into the single tenant side of the business was we started off with a very large neighborhood shopping center. And we were trying to sell it, couldn't sell it. What we were asking and where the bids were coming in at, there was a big delta. So I kind of just woke up one morning and I said, well, wait a minute. I'm looking at this. And if we parcelize the entire center, and we've got a bunch of the out paths as net lease deals, and we have the grocer and we have the drug as separate parcels, yeah, it's going to probably be about 7 different transactions, but I think we're going to get to our number. And so what actually happened, because of the cap rate compression that we realize with these single tenant properties on the sale, we actually exceeded what our original asking was with a breakup strategy. Once you get into the single tenant world and that business, all of a sudden you basically are on the map. And so you have people who bought the Taco Bell or the McDonald's say, guess what? I'm looking to buy more. So if there's any other opportunities, please keep me in mind. So you just sort of get baptized into that world through that type of transaction. But our day-to-day practice is both selling existing shopping centers from strips all the way to enclosed malls. And then on the net lease side, anything from fast casual, quick serve retail to larger Home Depots, Lowe's, and middle market soft good retailers that are net lease, like TJ Maxx, Ross, Marshalls, that kind of thing.
Yeah, a lot of names everyone knows. So what's the process like of breaking that up? I don't have any experience on the retail side, but if you're looking at maybe like a condo overlay regime on a single plat property for apartments or townhouses or that sort of thing, like I've seen those. So is it similar to that, or do you have to replat the entire?
Yeah. So the first example was we had an existing shopping center that was all parcelized already.
Okay.
We had CC&Rs and everything kind of built in there. That was easy. But I've taken existing shopping centers, that was just one parcel, and with engineering, basically record separate parcels and have CC&Rs, reciprocal parking agreements, et cetera, and then documentation on who's going to be managing the common area for the property. And it's typically the largest footprint owner in terms of square footage. And once you have all that in place, then it's fairly straightforward and easy.
Got it. Yeah. So the main cost is on the engineering and the legal side to get that in place.
And time, it just sometimes, everything's sort of relative. Now, I always refer to post-pandemic because you used to be able to do in a certain allotted time is not necessarily the same now because you don't have the staffing, you don't have both on the city level as well as in the private practice, you just don't have the bandwidth to manage it. And where you would be able to get things done relatively quickly within 6 months can take now up to a year and a half.
Yeah, we saw that firsthand. We have a development deal we're working on. It just took a year and a half at least. And we're finally at the tail end of it. We're like, thank God we're there,
Right.
So, all right, I'm curious. We'll take it back. And I guess for some of your bread and butter deals, maybe single tenant, that's kind of a topic we could touch on just out of curiosity. What does debt look like on those types of properties right now and compared to pre-pandemic or a year ago even? Like, what does a typical debt product look like?
Well, before the pandemic, you're on, let's say, a franchise, a well-established, well-heeled franchise operator, QSR, 100 plus, no, let's say 800 units. Okay. So largest, use my personal example, a KFC, largest Yum Brands KFC operator is KBP Foods. They have 800 plus units. We were able to get up to 65 to 70% loan to value at very attractive rates. Now it would be full recourse, 10-year money, very straightforward and very clean. Today, you're looking at probably 50% loan to cost, and a little bit more, not just the fact that it's recourse, but you may have lockout periods, you may have some prepayment penalties. And so there's a little bit more complexity in the debt structure today for those types of assets. It all depends on who the guarantor is, where the location is, how much term's left. So it's got some other intangibles to the asset, but that would change it and move it. And you've got credit union money that kind of spends a lot of time in this space. And these are usually loan amounts between $1.5 million to $2.5, $3 million in that range. And if you go in for larger portfolios, then, there may be some cross collateralization of those assets in order to secure that.
Yeah, that's what I was wondering. And is it 10 years? Is that typically like amortized over 10 years, or is that a full?
Yeah, you'd get 25 to 30 year amortization.
Okay. And that's land and building? Yeah,
depending on the lease structure. If it's a ground lease, then you're only financing the land and you don't own the building. But typically, if they're a build-to-suit, then you get both the land and the building.
And do you guys focus on one of those more than the other? Or it's just, again, how it comes?
It's just how it comes. For example, on McDonald's, Chick-fil-A, they're all ground lease transactions.
Yeah.
Very, 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 very rare that you would find a build-to-suit.
I'm kind of curious. Me on the investment side, and I'm a broker on the residential side, haven't done a ton on brokerage on the commercial side. We focus on multifamily and that sort of thing. So I want to talk to you about distress stuff again, kind of like what you're seeing in the market that's coming up, but still, like on the retail side, anybody who's looking to invest in these properties or become an owner in that asset class, like what are some of the risks associated with that aren't obvious from the outside looking in?
Well, on some of the larger retail big box type centers, you have what is called co-tenancy clauses. And what that basically means is, and this is right now relevant in today's climate, if you've got Bath and Beyond that says, hey, look, we're closing down our store before our lease term, and you've got Home Depot, you've got Marshalls and TJ Maxx in there, and Party City, who, by the way, filed bankruptcy. If one of those tenants, like Bed Bath & Beyond or Party City, close their doors, Ross or TJ Maxx or Marshalls or Home Depot, they have in their leases that, hey, if one or more of those tenants close and are not released within a 6-month period, our rent goes to 50%. And then if it's not leased up within a year, we go to no rent or percentage rent. And then if it's not leased up within 18 to 24 months, we actually have the right to terminate our lease. So what it creates is a domino effect of erosion of NOI that, unless you really read the lease documents and understand it, the repercussions could be devastating to an owner-operator. That is the one key driver that you need to really be aware of and pay attention to, because I've seen owners literally know how the script is going to play out, and they just end up tossing the keys back to the lender. They don't even try to fight it. It's
what's the timeline on something like that? Typically, once you see something going and it doesn't lease out in 6 months?
Yeah, I mean, usually, and you have lease administrators at all these retailers. That's what these guys are paid to do, is figure out and pay attention to what's going on. They're pretty astute, and usually they will tell you before you, even as the owner, may realize what's actually happening and put you on notice. And so,
yeah, that's okay. That's good to know. Yeah, for sure. Watch out for that. Some of the other things that I want to talk about, I guess, again, on the investor side, I want to kind of guide the conversation into what it might look like to invest in one of these properties. But knowing that, again, I compare a lot of things to multifamily and cost segregations and the tax benefits and those things that you can get as a real estate professional. With retail, I don't know how that works and how that operates. So what are some of the benefits of owning retail in general?
From a multi-tenant retail shopping center standpoint, you're spreading the risk typically, where you've got multiple tenants and sources of income. Other ways to derive income, and in today's EV marketplace, having charging stations in your parking lot as a source of revenue. I'm working on a deal right now with Tesla where they're going to pay some pretty healthy rent for a nice 10-year period. and they're putting in all the infrastructure. We're over parked at the center, and so it works out very, very well. So you have that diversity. If you lose one tenant, it's not the end of the world. You can usually, hopefully, backfill that. And so you're spreading some of your risk there, and the yields are there. In net lease, you're one tenant. So if you do lose that tenant, depending on the location, and that's what really sort of drives the narrative here, is I'm a firm believer that if it's good real estate, it should always be good real estate. So we start with looking at the real estate first, then we figure out who's the tenant that is guaranteeing that income stream at that location. If it is a weak operator, franchise operator, and they go out of business, but it's a hell of a location, well, chances are a national corporate tenant's going to say, hey, look, we're not in that market. We like that location. We know what we're doing. We can make it work. And I've seen time and time again, a Chick-fil-A will come in to a market where they've had barriers to entry and have had an opportunity based on a weaker mom and pop or franchise operator, and they've been very successful. Again, it goes back to the real estate and how they make it work. The cost segregation that you alluded to is very common and popular in the net lease world, typically where you actually own the building. You can't cost segregate on a ground lease, but it is very effective, and a lot of my clients pursue that strategy as a tax savings vehicle.
So when you're looking at these types of deals, I assume if it's a family office, maybe they're buying it themselves and they run it themselves, that sort of thing, and not going for outside equity or capital. On deals where there are offerings, either syndications or funds are going in, like what types of returns are they typically offering to investors who are coming in as LPs? Are you seeing those offerings?
Yeah, I think what you're looking at today's environment and it kind of goes with who the guarantor is, right, on the lease. So if it's franchise credit, depending on how strong the franchise operator is, commensurate with the cap rate and the yield that you're getting, I'm typically seeing at least 7 to 7.5 on franchise credit in secondary and tertiary markets of the country. In primary MSAs, we basically are seeing 75 to 100 basis point compression on that cap rate. It's all relative. That's the expectation for an investor to come in and possibly get a yield. Again, a lot of it is driven by the term of the lease and the story behind the guarantor. In other words, is it a sale leaseback? Is it more than 10, 20, 30, 40 units that are guaranteeing the lease to kind of move that return, that yield upwards or downwards, depending on the risk factor. And also the location, again, goes back to if it's good real estate, there is barriers to entry and some constraints with supply, then there's value there. And so you can sell that story.
Yeah, for sure. Let me try to rephrase it maybe, because I don't know if we're on the same page there. If I'm putting together a syndication, I want to come acquire something that you're selling. You say, Randall, there's a great opportunity. Come by. It's a corner lot, and then you're going to put Chick-fil-A there, right? Mm-hmm. And I go out to syndicate that deal or raise capital or something or fund again. Are you seeing the offerings sponsors are taking out to the marketplace to their investors? Because I just don't look at these types of deals, and I don't know if they're out there or they exist, or if this is like if somebody's buying a whole mall, are they syndicating those deals, or is it an institution that's coming in and buying it? And then if it is, then what types of returns are they offering in their fund? Yeah. Again, because on the multifamily, I'll just relate it back. Obviously, on the multifamily side, there's a lot of people operate on like a 7-pref with a 70-30 split. That's kind of like the syndication model. I don't know if there's something comparable to that in the retail space that you're seeing these guys go out, raise capital for their deals, and what that looks like for their return profile they're offering their investors. Yeah. Yes.
70-30 is typically the split with pref. What they're looking at, there's some additional sponsor fees and things like that and management fees kind of built in, but typically that's the same type of structure. Now, on the institutional side, it's a little bit different. They're more with their cost of funds and their ability to access the debt markets. They're able to drive an IRR that might juice it up a little bit more than a private client individual.
Yeah. So are you seeing more ref equity coming into the market on deals, or is that just
it all depends. I mean, right now we're kind of going through a transition period where I think people are either hitting the pause button and waiting to see what the Fed's position is going forward on interest rates, what's happening with the economy, where things are just sort of landing. Now, if you look at multifamily, it seems to have always been a investment choice for investors. It's people need a place to live, and we've got a housing shortage, an affordability index, and things of that nature that really drives that sector. However, we're seeing a lot of recent distress and opportunities in that sector from people who are kind of stuck, based either what their basis is on the property or what they were trying to do with the asset, and they bought it with bridge money and unfortunately aren't able to refi out of it. And so they're upside down on the deal. But I mean, it all depends. Even the 1031 exchange money is relatively drying up. When the transaction volumes somewhat curtail, and you don't have the machine moving, you don't have the velocity of transactions, and it just sort of slows everything down. You have people that are looking at other investment vehicles such as the stock market and equity markets, and they're looking at, I'm getting hammered there, so do I look at real estate as an asset class? It's a hard asset. I can actually touch it, feel it, experience it, and put my money there. And so it all depends.
Yeah.
And then again, right now, I think office as a product sector is especially when you're talking Class A office, is a very, very tough sell in today's environment. And we're seeing stress in that sector in all the major markets.
Yeah, I just read about Chicago. Who was it that just exited or just dumped? It was a ton of space on the market. I can't remember. Salesforce, maybe. I think they just dropped a large space. Yeah. All right. I guess staying with the retail still, just because I'm kind of curious and trying to learn about it myself. Deal, when you have, let's say, again, I'm going to relate this back to agents and kind of get to where maybe there's some low hanging fruit if people are looking to invest and how they can get into it. But knowing that, kind of curious, like, what does a full cycle deal look like for somebody coming in? Are your typical clients buying it and they're operating it for the 10 years and then selling it? Are they refinancing it and getting a new lease term or extending the lease? Or is it, again, like easy related back to multifamily? They get out, like the typical cycle of a deal is 5 years, right? That's what we're all pitching. It's, 3 to 5 years. We're going to exit, double your money. So again, on retail side, do you find more long-term operators, they want to hold it forever? Or is there like a 3 years and exit type deal?
It all depends on the story and the individual deal. High level, it used to be 3 to 5 years. Now it can be 5 to 7 years, but you make your money on the buy, right? So if you're buying in today's environment correctly, and there is a story, meaning there's upside, you're getting vacancy for free, so that if you lease that out, you are moving the needle on your NOI and obviously capitalized value. Or if there is aspects of the asset that you can grow the NOI. As I mentioned earlier, creating charging stations, for e-vehicles. If there is an opportunity to create a pad on the site that you'll be able to ground lease or do a build to suit. Back in the day, cell towers used to be another revenue source, billboard income. You don't see too much of that now. It's already, the infrastructure is pretty much in place. But again, it will take longer to lease up a property. Your investment horizon just gets pushed out more. But typically, it always has been 3 to 5 years, but it could take 5 to 7, just depending on where we are in the marketplace and what the future looks like. I think everybody agrees that the future for where interest rates will be lower a year from now than they are today. And the question is, how much? That all plays into it in terms of cap rates and where people want to exit.
Yeah. What are you most excited about though in the retail space right now? Like what is low-hanging fruit?
Well, I think it's daily needs retail. I mean, when you look at the fact that leverage technology systems where you never have to leave your home for goods and services, people need to experience and get back to what their routines were, which is even just going to the grocery store. Look, there's some people that don't care about somebody else picking their tomatoes or their apples or getting their groceries and having it delivered to them. But there are other people that say, no, I'm foodie. I'm really into cooking. I'd like to talk to a butcher. I'd like to look at the cut of meat. I'd like to have it catered to what my needs are. That's not going away. And if anything, we're seeing a huge resurgence on that. Supermarket anchored retail is a dominant investment class in retail as a sector and does very, very well. The next one that falls into is convenience. Your 7-Eleven, your Circle K's, your Wawa's, anything that has kind of a grab and go type structure is very appealing. If they're saying, hey, I want to get a Coke. Well, you don't go to a Kroger to get a Coke. You're going to go to a 7-Eleven. You're going to go to a Circle K. And other services that are needed for people's daily needs and their lifestyle, whether it's beauty, nails, food, obviously, it's the key driver. And that is doing very, very well. And again, where we may have seen some weak operators fall off during the pandemic, what we actually saw with 95% of the others is a strengthening of that sector and huge sales and growth. Because you have, for example, I'm going to use the KFC as my illustration here. When I spoke to the CFO of KBP Foods, he said to me, he said, Chris, we were crushing it during the pandemic. And I go, well, tell me why. He goes, it's real simple. Our drive-through was stacked usually 8 to 10 people. We're COVID compliant or virus compliant. I'm going to just use that because there's probably going to be future viruses. And then we had meal delivery services. And we also had online ordering where you can show up and people would come out. We didn't have people dining. So our normal shift was 5 employees. We cut that down to 3. Sales are boosted. Expenses are dropped. Our EBITDA was off the charts. And so that model worked very, very well. I think you're going to see, I mean, you already see it now with Starbucks with their drive-through only concepts. That's going to be here to stay. And I think you're going to start seeing more and more fast casual operators have that type of concept, whether it's Chipotle, whether it's even Chick-fil-A. You don't need these large footprints. You don't need these playgrounds like you used to have. I mean, those things are biology experiments, for kids right now. And coming out of this virus, you don't need to have all that extra square footage. And people really don't want to hang out. And it's more or less grab and go. Those are the types of retail that are very, very successful today and will continue to be.
We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com.
Yeah, it's been interesting to see that change for sure. Chick-fil-A's having 2 lanes. They were pioneers, I think, like front, at least here in San Antonio. I don't remember any other, maybe Whataburger, but having 2 lanes and then they're just always stacked and busy. So you were saying something about the grocers being the anchors. And so I wonder, are you seeing a shift into like specialty? Like the butcher who actually has a butcher shop, or is it still just, I want to go into the Whole Foods of the world and actually touch it, feel it, smell it, and buy it?
Yeah, it's more of that. I mean, you do still have the old school butchers in certain markets, but primarily it is competent people behind the counter in the meat produce section that they know what they're talking about. And so you could say, hey, look, this is what I need. And this is what I'm thinking about. This is my vision. I'm hosting 4 people for dinner. This is what I'm serving. What are your thoughts in terms of how much I should have, et cetera, et cetera, as opposed to trying to figure it out on yourself by yourself, doing it online and realizing, I wanted 5 pounds of veal, and what I ended up getting was 5 pounds of pork, right? So there's something to say about engaging with that human interaction in order to meet your expectations.
Yeah, for sure. Another question is around an office space. We don't have to talk about office, but on the retail side. So I guess how they relate. The office space, I'm hearing there's a lot of talk about converting those to multifamily, to storage, to something, right? To build that space. Is there a big push, or have you seen a push to convert some of these strip malls into storage facilities? Do you do any of that? And is that actually taking off?
In the larger enclosed mall concept, what I'm seeing is dysfunctional department stores as we have known them. Basically, that model is becoming extinct. So what you're seeing is conversion of those anchor boxes into alternative uses. Usually what I've been involved in is last mile distribution with Amazon for some of their warehousing. It also can be self-storage broken down into self-storage units. I've been involved with a former Kmart where everybody was looking at it, trying to figure it out from a retail concept. And this guy came in and said, look, I got to tell you, I don't think this is a retail site anymore, and I'm going to buy it and I'm going to convert it to self-storage. And it was a home run. It was successful.
Yeah.
And of course, the cities don't like to hear that because they love the sales tax revenue from retailers. But at the end of the day, they have a choice. They either have a dark, closed down site that's an eyesore to the community and can attract bad things and bad elements, or they could provide a community benefit and turn something around that's normal and eyesore. It just depends. Office conversions to alternative uses such as multifamily, it has been done, but it has to be bought right. There's certain types of buildings that you could possibly do it based on the floor plates, but it has to be done right. But you have to buy it right, I should say. And we're talking about between $100 and $120 a square foot on the office because of the amount of money you're going to have to put into it. But there's certain office buildings that aren't set up where they actually have parking in it. It's based on the vintage and where it's situated in some of these MSAs. And so the question is, will this become, if it's not conducive for today's office user? And that's the big unknown, is got these beautiful classic architectural buildings, but they're functionally obsolete as an office user. So,
yeah, I'm watching that and curious. There are a few guys that I know that set up funds specifically to go out and take down the malls and that sort of thing to convert them. And so they were having success doing that. I just was curious if you were seeing that as a wide scale sort of adoption happening across the country.
Well, I've sold 3 malls. All these are B and C class malls. And, the yields going in, 10, 11, 12 caps on 40, 50% of the actual NOI. And then the ability, and you're looking at a price per pound, it's $11 to $20 a square foot. I mean, it's really, really cheap real estate. So you've got a lot that you can do with it. And in one instance, a mall in Oklahoma where you got everything, including all the anchors. And so they took an old Sears, cut it in half, and the post office rented half of it. And they said, oh, you don't have to do anything in terms of TIs because it's going to be a post office. We just need you to build out our front kind of showroom, which was only about, I think, 1,500 square feet and some mailboxes. The rest of it is warehouse because of how they are going to use it as a distribution hub. And then the other half was a Planet Fitness. So that's just one example. Then they took an old J.C. Penney's and made it into an open air event center, kind of a stage, a theater. Country music bands would kind of roll in and drop by, and the city was behind that. And then by doing that, then you said, well, we got to have food, we got to have other entertainment, and then we've got all these pad sites. How about we do some multifamily? How about we do some hospitality? How about a little creative office? Oh, and how about some medical? We did an urgent care. We did a dialysis center. All of a sudden, you've now transformed this albatross now into a functioning community type center that wasn't really designed for all these types of uses. But in today's environment, it works and it's a home run.
Yeah.
It all gets back to your basis and what you buy it at.
For sure. I mean, those are interesting. There's one here in San Antonio that we talk about, ULI group, and we talk about just how to work in some of these retail spaces that are just dying, and you can see it's dying, and they have too much parking and that sort of thing. And one of the big talks is how do you build what ULI defines as like a thriving neighborhood, 15-minute walkable, you have a grocery, you have everything in one spot. Yeah, if you're able to do that, the entertainment and all of that, it sounds like that would be successful, but obviously you have to buy it right. Look, I want to bring it back to a lot of agents who are mainly on the residential side for the most part, I would say. It runs the gamut. Like I have some guys I've talked to, they're 70 million a year, like top producing agents. Some guys are just starting out and that sort of things. I want to really on the retail, your very specific specialty, discuss some of the opportunities that may work for a high income earning real estate professional to go out who wants to deploy some capital into an investment. Like what is a deal that you would recommend somebody just had a good year and they need to put some money to work? They want to buy something, and like what would you recommend? Like what's a, I guess, low hanging fruit type thing?
Convenience strip center retail, infill, supply constraint, corner strip center. And it doesn't have to be named national tenants, but good operators, mom and pops, people that have in business for quite some time and are sort of known in that community. And it's the go-to place. Balance of services as well as, food uses, and you're golden. It's absolutely, if you've got barriers to entry, you're not going to have competition. So chances are you're not going to have your tenants say, hey, look, I'm not making money here. I am making money here, but I've been offered another opportunity down the street. Well, if that doesn't exist, you kind of have them as a captured tenant. And the chances are you're going to be able to move the rents dramatically, possibly even exceeding market, because it's impossible for them to leave. And their business is so good, they're established. The cost of them to relocate and the goodwill that they would potentially lose could be dramatic. That's the type of investment that I have invested in, that I recommend, and would be a go-to for someone starting out.
So I get looking at deals all around town, all around Texas, all around the country, right? What are the quick go, no-go sort of things you look for on that front? You're saying, okay, it's a corner, it's got these guys. Is it exactly what you just said, or there's some other things when you're getting to, before you underwrite a deal?
Yeah, you want to look at, there's a hard corner and a soft corner. A hard corner is a signalized intersection. That's got the heaviest traffic versus a stop sign on one of the access roads. Ingress and egress into the property. If you only have one point of entry and one point of exit, that's a problem. You need to have at least two, if not additional access points to get in and out of for convenience. The condition of the real estate. Is this lipstick, or is this actually major structural work that needs to be done, and what's involved in that? And then the other is just kind of looking at the center morning, noon, and night, and just kind of getting a feel for traffic patterns and walkability index. Is it in a location where, yeah, you do have car traffic, but is there also public transportation close by, whether it's a bus stop, a metro stop? Do you have density of residential, meaning apartment buildings in the area where these people can walk to patronize the center? all that kind of comes into the equation.
Feeds that spot. Okay. Yeah, that's great advice. And similarly, that's somebody who may have a decent amount of capital to put to work. If somebody's newer, they're looking at, retail as an asset class, maybe they don't have all that much money. Is there a place they can get started or start investing? Or is it like, look, this is for the big boys. Just find a fund you can put $25,000 into.
Well, yeah, you could do that. Thank you for your money. We'll get you your dividends, and we'll maybe report to you on a quarterly basis or yearly basis, whatever kind of thing. Don't call us, that kind of thing. Or you can put together friends and family and put a small syndication together. And that way you can get a little bit more involved and have some buying power. But I think at the end of the day, you're looking at least $50,000 to $100,000 as equity investment in some of these strip centers. And when you are underwriting these deals, you also have to make sure that the sponsor illustrates reserves for CapEx and leasing commissions, tenant improvements. Whether even if the center is 100% leased, you still want to reserve for that in your income and expense operational illustration, so that when the opportunity comes, it's not a cash call. It's not a, hey, by the way, we're not going to fund any dividends this month, this quarter, because we need it to go towards CIs, tenant improvements, and leasing commissions. Well, if it's already reserved in there, that's a good operator, somebody who knows how to manage and operate these types of properties.
Yeah. All right. Great advice. If you're looking in this space, so you are on the brokerage side and you help people find and execute on these transactions, right?
Correct.
I'm happy your contact information is going to be below. If you are interested in this type of thing, I would definitely reach out. He's going to be able to help you and guide you in that sort of investment. I want to wrap up with just a couple questions I ask everybody at the end of the show. What's your favorite pastime not related to business? Get to know
Golf.
Chris. Golf, my man.
Golf.
That's what I'm talking about. Favorite course? You got local course or?
Well, it's kind of like picking your favorite child, but I mean, I'm a big fan of Pebble Beach. My first time I played Pebble, I shot horribly because I was just in awe with the beauty of the course. It's just, there's something about walking a great course. I've Colonial in Fort Worth in Texas. That's a beautiful track and a great experience. It's hard to say. I mean, Hawaii, there's some beautiful courses, are breathtaking.
You play
Cabo. What's that?
What's the one at the very north? Is it Kaanapali?
Well, on Maui, yes. Yeah. It's actually Kapalua you're thinking.
Kapalua, that's what I'm thinking of, yeah. Kaanapali is the town just south in the middle of the island. Yeah, did you get over and play anything near the Four Seasons and all of that? There's like the gold and the...
That's Wailea, and they've got a boatload of courses there, and I've played all of them. And then going further out into McKenna, there's great tracks there. And Kauai now is got some amazing courses. Yeah.
The first time and only time I played at Pebble was my brother's 40th. We got out and we were like the first one to tee off. It was a week before the Open, the 100 years, and it was in like very difficult conditions.
Sure.
I was happy with the way I played in those conditions. I think I shot like a 90, 92 or 94 or something like that. But it was tough. And you're right. It was a beautiful course. We played all those courses out there. That whole area is amazing.
Yeah. Spyglass is also another classic.
Yeah. Yeah. We played there. Then on the way up, we played Pasatiempo on the way out of town. Yeah. A solid track too. So, okay. Best thing or memory that's happened to you or your family in the last 60 days? Recent memory.
Best?
Yep.
Recent memory? Celebrating my 18th wedding anniversary.
All right. Congrats.
Yeah.
That's very nice. And name one or two people who have been most influential to the way you think or to your success.
I would have to say I've had mentors and business coaches throughout my career, but one person that I still keep in contact with that was a guiding force was somebody that I worked for at a previous company and just played golf with them out in the desert. It's always easy that even after time and years, we hadn't seen each other, we pick up where we left off and able to bounce off ideas. And he has a way of asking certain questions to get answers out of me that I normally wouldn't share, and then building upon that and saying, well, have you thought about trying this? So it's a lifelong friend who has been a very good mentor to me and sort of guiding light.
Yeah, that's very helpful when somebody asks you questions to get you there rather than saying, hey, Chris, you should go do this. So,
correct.
Okay. Yeah. Thanks for the advice there. All right. Well, Chris, it's been a pleasure getting to know you, chatting with you. Thanks for sharing your knowledge and information. Retail space for me is new, so I'm sure it is for some listeners as well, because it's not what we cover all the time, but it is interesting, especially in this environment, looking at different types of things that I can invest in myself. So I appreciate your information. Thanks for jumping on.
Absolutely. Thanks, Randall.
All right.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.